Hello everyone, welcome back to part 2 of our discussion of itemized deductions. We left off looking at, after doing medical and taxes, now we're ready to take on interest. So home mortgage interest is probably the biggest amount that people have in terms of itemized deductions. And so it's often the thing that determines whether or not they have enough total itemized deductions or not, is how much they pay on their home. And so it's the loan to buy or your residence. You get 2 houses, okay? It can be up to 2 homes. The third home is not count. The second home could be a fully equipped motor home, as long as there has bathroom and kitchen inside, okay? So it's somewhat broad, but there are some limits, okay? It can't be total loan amounts, no matter whether it's 1 or 2 homes or whatever, can't be more than $750,000, and half that if you're filing separate returns. Okay, so if you have, and that sounds like a lot of money, but in certain parts of the country where prices for real estate have gone up substantially, it would not take that much of a house to be more than $750,000. So it counts if you use the amount of the loan to either buy the house or improve or fix it up, the house. So that's especially true with a home equity loan, a second mortgage. It used to be that it didn't matter what you spent your home equity loan or your second mortgage on. It was still deductible as long as it was secured by the residence. But that is no longer the case. It's only if you use that to something on the house. So that is a very real limit. Now, just a little bit about the $750,000 limit is per individual, okay, not per residence. All right, as been appealed to the courts, and the courts have come down and said Congress meant that it should happen based on per person. And that's the same thing whether it's a home equity loan or whatever. Now, when you buy a house, many times you would pay what's called points, which is basically prepaid interest. It gets you a lower interest rate by paying an amount up front. Now, the general rule is that when you prepay something like that, you don't get to deduct it now. You have to deduct it over the life of the loan. Okay? So that's the general idea. But as you'll see, sometimes there is exception to that rule that's based on it being your principal residence. So you could only have this with your place you live, not your rental house, not your vacation home, none of those, not your second house, but the principal residence. You can only have one principal residence. So if it's for your principal residence and it's the normal course of business, which it is almost everywhere, to buy points and to get lower interest rate because you pay it up front, then it's all deductible that's at the time you pay the points, which is usually at closing when you buy the house. So it gets you a big deduction right up front. Private mortgage insurance. This is not homeowner's insurance. This isn't the insurance that covers if your house burns down or gets flooded or something like that. None of that. This is private mortgage insurance is insurance that pays helps pay off your mortgage if you can't, okay? So the lender is the one that's going to get the benefit of this. Typically, the lender, the bank that loans you the money to buy the house, is going to require this if your equity is less than 20% or if you borrow more than 80%, however you want to think about it. Okay? So they're going to charge this private mortgage insurance. They'll report it to you on the same form as they report the interest you paid. You don't have to necessarily keep track of it. The bank is going to send you that and tell you how much you paid. But it is deductible as interest, even though it's technically not interest. It is deductible in the same spot on the Schedule A as interest. However, it does get phased out. Okay, if your AGI exceeds 100,000 and it phases out fairly quickly, meaning it's all the way gone by the time you have income of 110,000. So basically, percentage-wise, between 100 and 110. The last interest that is deductible, okay, and notice there's a lot of interest that isn't deductible. Interest on your car loan, interest on your credit card. All those are personal interest and are not deductible. Investment interest is interest you paid to borrow money to buy investments. That's what investment interest. First of all, if you buy investments that are tax exempt, remember we talked about in Chapter 3 that tax exempt income, for like interest on municipal bonds or state bonds or things like that, is not taxable. If you buy that with your loan, if you borrow money and buy non-taxable income generating investments, you cannot deduct the investment interest. That's the deal. So since you don't have any income from the investments, you don't get a deduction for the interest you pay to borrow the money. But if you borrow your money and buy regular investments that provide taxable dividends and interest, then you can deduct the investment interest. And remember, this is still just goes into the pot with all your other itemized deductions and only counts if you got enough for it all, over the standard deduction. But this investment interest also has an additional limit, and that is the investment income. So if you borrow money and pay, let's say, $400 of interest for the year to borrow this money, you took that money you borrowed and invested in bonds that made you $300. Okay, so it sounds like a pretty bad investment, first of all, but you can only deduct up to $300. You cannot deduct the full $400 because you can only deduct up to the amount that you earn in investment income. And any additional has to go forward to next year. So it's carry forward. Now you could make interest income next year and use that, but you also may have investment interest expense next year too. So that's the situation with investment interest. It gets listed on the Schedule A as well, and it doesn't necessarily have a place to figure out your limit that you have on investment income on the form. It's not explicitly stated there. So you have to remember to make sure that you don't take more investment interest than you are entitled to. All right, charitable contributions. This is also can be a big deduction for some people. Okay, so what you have to look at is what is being donated. If it's cash, it keeps everything relatively easy. Okay. But it has to be of some value. Donating your services, your time, that sort of thing is not a charitable contribution. And it has to be to a charity. It cannot be to a friend or an individual. It has to be to an organization. Otherwise, it's not a charitable contribution. So there's limits to how much you can deduct. For cash contributions, they raised it for 2020 and 2021, okay, to 100%. Basically, to really encourage giving to charity. Other organizations that are not charitable, and when we say charitable organizations, we're talking about what we refer to as public charities, the ones you would see and think about when you're talking about charitable churches, Red Cross, Salvation Army, those types of organizations. Now, there's a whole bunch of them, and there's a whole list. The IRS publishes. But there are other organizations that are not what we call public charities, and they have a 60% limit. Now, we talked about this briefly earlier again. If you don't itemize, see this again, all these donations don't count unless, or don't give you any benefit unless your total itemized deductions are more than your standard deduction. Except for in 2021, $600 could be used as a deduction. It is from AGI, but it's not listed on the itemized deductions sheet, not Schedule A. It's listed right on the Schedule 10, on the Form 1040. Now, what about other types of property other than cash? People want to donate real estate or stock or other things. Okay? If it is capital gain property, and that's all your stock, bonds, any type of investment, real estate, those would all be capital gain property that has gone up in value. You can donate that, but the limit is lower. The amount that you can deduct is only 30%, and you always have to apply the lower limits first. Okay? You see what the limit is for the property, and then if you have any additional cash donations, then you look at that to see if it's up to 100% or whatever. Okay, if you capital gain property to private foundations is only 20%. Private foundations is really a organization that is funded primarily from one or two, maybe a family. So the Ford Foundation or the Hewlett-Packard Foundation or some of these, the Carnegie Foundation, those are all private foundations. The money that they have came from just a few people, not from donations from everybody at large. Now, if it is non-cash and not capital gain property, typically inventory, then it's a 60%. But, okay, in that situation, you deduct the cost of the stuff you're donating, not the value of it, not what it's worth. All right? If you donate stock, you actually can take a deduction for the value of the stock, even though you may have paid for it a lot less than that. So that's what this talks about. It's typically, if you use a public charity, deductible donation is a fair market value. Now, the exception to this is that if it's tangible personal property. Tangible means physical, so a piece of art, a statue. Okay, something like that would be a tangible personal property. All right? If that donated property is put to an unrelated use, then we're not going to get the value of it. We'll have to use the cost. The fair market value is not what we can use for our deduction. All right? If it is put to a related use, then we can use a fair value. So, example, okay? I give a piece of art to a museum. They are going to put it on display at the museum. That donation can be valued at the fair value of that artwork. And I can take a deduction, charitable contribution, for the value of that piece of art. If I donate my piece of art to to the Red Cross and they just sell it and use the money to help people, which is fine, okay? But at that point, I don't get to use the fair value. I have to use the cost of that asset as my donation amount. This also applies to any property that I hold or have for less than a year, right? So even though stock, is intangible and can be donated and used for fair value, that only applies if I've held that for at least a year. Okay? So typically, if it's less than a year, then I have to use the cost, not the value of that. It's not that we can't get a deduction or it's not a charitable contribution, but the value of it can't be, we don't use the fair value, we use the cost. Now, in general, if someone's asking you, and the assumption is usually made in the tax law that when somebody has property and they're going to donate it, something other than cash, that we assume that they bought it for, let's say, $1,000 and now that's worth $5,000. That's why they would want to donate it, so they can get that donation of $5,000. If they had bought it for $5,000 and it was now worth $1,000, they should not donate it. Anybody that understands the tax law would say to that person, don't donate that. Sell that property for $1,000. Take that loss, okay, which can be deducted at least partially on your tax return, and then give the $1,000 to the charity. Okay? Charity's in the same place either way. They got stock worth $1,000 or $1,000 in cash. But you're better off because if you gift it to them, you can't deduct that loss on the property. All right? So the assumption is that when we give property to a charity, it has gone up in value, and that's why we want to give it. What about, how do you prove that you gave this? Okay, these have become more stringent over the years. The nonprofit has got to do a better job to giving you a receipt, giving you a statement saying this is how much we received from you, that sort of thing. That written acknowledgement is required for anything over $250. Okay, if it's less than that, then a canceled check might work. If you are limited, meaning you have more charitable contributions than you're allowed to take because of the percentages, you can carry it forward, but only for 5 years, meaning you have to use it in the next 5 years or it goes away. All right. Tax law changed back a few years ago. Drastically changed casualty and theft deductions. Now this casualty is deductible only if it is in a federally declared disaster area. So it used to be that as long as if you had a casualty loss, means someone stole your car and you don't get any insurance for it, whatever, so you have a casualty loss, a theft loss in this case. Casualty the same way it could have washed away in a flood, whatever. Okay, that loss would be deductible based on some other limits. But now it's even more strict, and that is it has to be a federally declared disaster area. So what is a casualty? It has to happen suddenly. It has to be identifiable to the thing. It can't just worn out. So your house falling over has to be due to an earthquake. It can't be just because it was neglected and it slowly started to deteriorate. Okay? You have to own the property, and then you have to not have insurance pay you out. So if your house burns down, insurance pays for the whole, you didn't have a loss, okay? So you've got to consider how much insurance you get paid. If your car gets stolen and the insurance pays you cash, then you don't have a loss, except to the amount that they didn't pay you for. So if your car was worth, $50,000 and they only pay you $30,000, then you can say you have a loss. So typically when we have to calculate that, we're looking at the fair value of the property before the disaster or whatever, and fair value after. Okay? That's your loss. If it's gone, if it's disappeared, if it was never recovered, then obviously the fair value before and then after, after is zero. But if it's still there, it's just damaged, then that's how you do it. Now that sometimes is really hard to do. What was it worth before? What was it worth after? So often what we use as a substitute is how much did it cost to repair it? How much did we have to pay? But you better keep your receipts and indication of how much it cost to repair it, and that you didn't, when you repaired it, make it substantially better than it was previously. You can't have a loss that's more than what you paid for it, the adjusted basis, okay, of the property. Now, after you determined you're in the disaster area, you have a loss, the insurance didn't pay you for it, okay. Now, okay, you have to reduce that because of the disaster, the total loss by $100. The deductible, if you will. Okay, who knows who dreamt that up, okay, but that is the idea. We're not talking about little disasters, we're talking about big things. And then, after you subtract the $100, it has to be over 10% of AGI. Just like medical expenses have to be over 7.5%, this has to be over 10%. So it has to be a big loss, okay, or you have to have a very low AGI. They go on Form 4684 if all of these things work, okay? And remember, it still is one of your itemized deductions. So you could have gone through all of this, subtract the 10%, still have an amount that went over 10%, and if your total itemized deductions are not more than the standard deduction, it still wouldn't do any good. There used to be things called miscellaneous itemized deductions. Those were also done away, okay? There's no miscellaneous itemized deductions anymore. No business expenses for using your personal vehicle, for driving for your work, your employer, that sort of thing. There was a whole list of things that have all gone away. The only things that are left are what we refer to as other, okay, itemized deductions, and the big one is gambling losses, okay? Buying lottery tickets that don't win are gambling losses, okay? Paying in for the pot for bingo, buying raffle tickets, all the times you put it in at the casino and lose, okay? That is deductible in theory, but here's the caveat. First of all, you got to be able to show that you lost, and many people do a lousy job of keeping track or having any kind of records of that. First problem. Second problem, you can only deduct the amount up to the amount you won. So if you bought 5,000 lottery tickets, all right, $1 a piece, you have $5,000 of gambling losses. But if you only have one lottery win that was $1,500, the most you can deduct for gambling losses is $1,500. And you have to put that $1,500 you won on your income. That is income. Okay, and then you have an itemized deduction of $1,500 in theory. Again, only if your total itemized deductions are more than your standard deductions. All right? So that is, sometimes people hear about that, gambling losses, they don't realize how limited it really is, and you have to be able to show the losses and to it's limited to the much income. By the way, they will send you a form telling you how much you win. You won't have any trouble with that typically at the casinos and places like that. Lottery tickets, all those will send you. But what they won't help you with nearly as easily is the losses. Although some casinos I have seen will give you since you're using electronic versions of all the games, they'll actually can give you a printout of all your losses. But typically you've got to ask for that.